Imagine watching an asset surge 5%, then plunge 10% in minutes. For a traditional long-term investor, that erratic price action is a nightmare. But for a disciplined short-term trader, a scalper, those violent, fleeting swings provide a dense concentration of opportunity. Litecoin, or LTC, thrives in this high-velocity environment. Created in 2011 by a former Google engineer, it was designed for smaller, quicker transactions than Bitcoin. If Bitcoin serves as the network's digital gold, Litecoin acts as its digital silver. This diagram shows exactly how that speed is achieved at the network level. While Bitcoin takes about 10 minutes to process a single block of transactions, Litecoin processes a block every 2.5 minutes. Combine that accelerated processing speed with a smaller total market cap, and you get an asset that reacts aggressively to volume. A 2% price move in Bitcoin routinely triggers a 4 to 5% move in Litecoin. Trying to capture these micro movements by buying and transferring actual coins on a standard crypto exchange introduces friction. The wallet setups, transfer times, and withdrawal fees immediately consume the very small profit margins you are trying to capture. The tool built for this specific environment is a contract for difference, or CFD. Instead of purchasing the coin itself, you enter a contract to speculate strictly on its price movement. This vehicle strips away the mechanics of ownership and replaces them with leverage and multi-directional trading. If you identify a downward trend, you can execute a short sell, profiting from falling prices, without the complex process of borrowing the underlying asset first. By decoupling the trade from actual ownership, your entire relationship with the market shifts. You no longer care where Litecoin will be priced in 5 years. Your only priorities are execution speed and the flexibility to trade in whatever direction the market moves over the next 5 minutes. Zooming down to the 5-minute chart reveals an environment that looks chaotic to the untrained eye. Surviving here requires replacing guesswork with strict mathematical measurement. Look at this single 5-minute candlestick. To quantify this action, we use the average true range, or ATR. This indicator calculates the exact average price distance a candle travels from its high to its low over a specific look-back period. If the ATR shows an average movement of 25 cents per 5-minute window, setting a profit target of $5 on your next trade is a statistical impossibility. The ATR anchors your expectations to current market realities. As we pan forward, we add boundary lines called Bollinger Bands. When these bands widen, volatility is actively expanding. When the bands contract, the market is compressing, often storing energy for an imminent, explosive move. You must measure the boundaries of the playing field before you step onto it. Quantifying the current volatility is the mandatory first step before executing a single trade. Once you know the math of the current environment, your entry tactic depends entirely on whether the market is pushing a strong trend or drifting sideways. This visualization demonstrates momentum scalping. When the market makes a decisive move on high volume, you wait for the price to break forcefully through a known resistance level and you ride the immediate upward energy for a quick gain. Conversely, when the market is choppy and trapped in a channel, you switch to range scalping. Here, you exploit the boundaries, buying near the established support floor and selling near the resistance ceiling as the price bounces between them. But an isolated price movement is never enough to justify a trade. You need confluence. This means requiring a secondary momentum indicator, like the MACD or the Relative Strength Index, to independently verify the signal before you commit capital. Profitable scalping rarely involves predicting the future. It is the mechanical execution of a predefined system exactly when and only when multiple data points align. In a market moving at this velocity, a single unmanaged price spike will erase dozens of perfectly executed winning trades in seconds. Capital protection is your only defense mechanism. The foundation of that defense is the 1% rule. You never risk more than 1% of your total trading capital on any single scalp. This diagram illustrates a secure trade structure. You identify your entry line, you set your target, and you immediately place a rigid stop-loss order physically outside the recent market structure, like just beneath a recent swing low. Now the math does the work. You take your strict 1% risk amount and divide it by the exact dollar distance to your stop-loss. That calculation outputs the precise number of Litecoin CFDs you are permitted to trade. If you let the fear of missing out push you to chase a massive green candle,
Or if you apply maximum leverage to a volatile asset, you override this math entirely. The market will reliably punish that lack of discipline. Even with perfect math, the system breaks down if your broker's infrastructure is slow. Wide spreads between the buy and sell price, delayed execution, and slippage act as invisible taxes that drain your carefully calculated profit margins. Mastering Litecoin volatility requires the discipline to execute the math, paired with an environment built for speed. Open an FXNX demo account today to test these specific strategies on a platform engineered for zero pip spreads and ultra-fast execution, and see the system work for yourself.